Um, Perfect. Okay. So yeah, gross profit, very important. Another one is net profit. So it's like, so net profit is essentially taking your gross profit minus your operating expenses. Or if you don't care about cost of goods sold, it's your revenue minus your operating expenses. So net profit is, when you hear the term bottom line, what's your bottom line? Well, there it is, right? That's where it comes from. It's your net profit. It's the last number on your profit and loss or income statement. And it essentially determines what your total profit is for your business. Very important, right? Like whenever you're looking to sell your business or looking to predict in the future, you need to really understand, did you make any money? Are you profitable? And is there room for growth? And net profit really helps determine that at the end of the day. So here's a quick example of what an income statement actually looks like. This statement could be smaller or could be much larger. And I'm not going to go into the nitty gritty today, but you're able to sort of customize the look and sort of visual appeal to your income statement. We have some clients really want the granular detail. So instead of just vehicle expenses, it's like vehicle expenses, fuel expenses, insurance, repairs, parking. And then instead of just like, accounting fees, it's like legal fees, bookkeeping fees, accounting fees, and so on. So there's more granularity if you want. I would say the more granular you go, the more work it takes to sort of sustain that type of format. But it does allow you to provide some more analysis on your financials, right? You can really look to see if your vehicle insurance costs went up. You can see where you spent, how much in repairs and maintenance. So you can determine, okay, now we're spending $6,000 a year to maintain our vehicle. Maybe it's time to look at buying a new vehicle instead of continuously to repair it. So, income statement at the end of the day can be as simplified or as detailed as you personally want it to be. And I would say start off easy, start off small, and then slowly work your way to more granular detail if you need it, Like I have some businesses we work with easily over $1 million in revenue. And they might only have double these accounts. It's not a requirement to have 100 accounts to be analyzing and to be going through. You can have 20 or 30. There's nothing wrong with that. So just do what you need to do for your own sort of like format. Okay. And again, remember, if you have any questions, stop me if I'm going too fast. Like if you want me to clarify. Oh, question. Love it. Yay. Okay. What are your thoughts about putting production labor in Cogs or putting all labor together in labor expenses, given that we are running micro businesses? That's a really good question, Tom. What I'd say is it depends on your industry. So production labor, I would say, should 95% of the time be in a cost of goods sold, because you should, in essence, stop production labor if you're not selling anything. That's not always the case. Sometimes there's a lag. Sometimes there is a lag between when you're actually selling and when your production is ramping up. But for all intents and purposes, we typically see a correlation between production labor going up and revenue going up. Now, again, it depends on how large your business is. This might be a larger lag where you might have a 3-month production sort of timeline before you even start selling that specific item. But for small businesses, I'd say production labor should totally be a cost of goods sold. And then your labor, depending on your payroll software or how you track it, you can split like your management labor or your like non-production labor in the bottom line, your operating expenses. And then you can put your production labor in your cost of goods sold. So if you have a marketing person, an office assistant, a manager, a CEO, whatever, they're all like getting paid salary or wages. You can put them in the bottom line, the operating side, and then your production labor could be top line or your cost of goods sold. But some clients don't care. Some clients are like, whatever, like do whatever's easiest, like, and you can dump it all into one account if you really wanted to. You will have to show me in my QuickBooks how to split production labor and operating labor. Yeah, sure. If you want a quick answer right now, in the top right corner, there's a little gearbox. You can, under the payroll settings, you can allocate which employee belongs to which wage ledger. I can shoot me an email. I'm happy to give you a quick 2-minute video on how to get that done. Balance sheet. So although the profit and loss is like the most important for a business owner, for a bookkeeper or a tax preparer, I think the balance sheet is actually the most important. This is where I see garbage. This is like where if I walk into an accounting system, I know when there's errors happening. I feel like the balance sheet is like the garbage dumpster fire of like the accounting system. It's like where if you don't know where it goes, just put in the balance sheet because like I don't want to look at it. I'm going to hide it. It's like you're just trying to put it somewhere so you don't have to like look at it ever again. That's where the balance sheet items live. But it's actually very important for lenders, for instance, if you're ever going through a banking or loan process, they actually really care about the balance sheet. And it's because it highlights your assets, right? So it highlights how much your business owns that have a dollar value. So inventory, accounts receivable, equipment, cash, right? So these are very important items for your business, but also highlights your liabilities. So who you owe and what you owe. So things like accounts payable, taxes to the government, HST, any loans you currently have on your books. And then the last part of the balance sheet is the equity, which essentially it's money that belongs to the business owners. That's sort of one way to look at it. That kind of, it can be a bit more complicated than that, but essentially is like if you sold all your assets and liabilities, the equity is like what's left over. So that's like your formula balancing act on the balance sheet. So this is an example what a balance sheet looks like. Very simplified, right? But you have like your assets, which is the total value of your equipment, accounts receivable, and your bank account. You have some liabilities because you have some debt. And then your owner's equity essentially is what is the value of the business sitting on today. Now, the equity doesn't mean what your business is worth. It just means if everything was sold and disposed of today, that's essentially roughly what you'll be sitting on in the business. But your business could have more value to that, right? My business, my value is my customer list and my branding and my training modules that I built for my team. For a manufacturing business, it could be the efficiencies and productivity line. It could be the contracts that exist. For a construction business, it's all different. Every business has a different sort of valuation component. But just know, just because you have low equity doesn't mean your business is worth nothing. They are sort of separate numbers. Cash flow statement. So I would say it's definitely the more complex out of the three. So profit and loss is the most important for a business owner. I think a balance sheet is really important to have it correctly in a pinch, because in case you even need to get a loan with the bank or have a bookkeeper and accountant jump in. But cash flow is a very complex and sometimes difficult to understand report. And there's a few sections of a cash flow statement. So just to briefly talk about it, we have the cash flow from operations, which is the cash earned or spent in the course of a regular business activity. You have cash flow from investing, cash earned or spent from investments your company takes, and then from financing, which is the financing activity. This will determine if you've received or attained a positive or a negative cash flow in a specific period of time. One of the most common questions I get by far is, oh, my business was profitable by this much, but where's my money? Like, I should have that much money in my bank account now. And the answer is no, not entirely. A very quick example is if your business made $50,000 in net profits, but you personally took all that money out or you used it to pay off debt, well, that wouldn't show on your profit and loss statement, right? You still made $50,000, but you used it to pay off debt. So if you go backwards in time, if you go back to this part of the balance sheet, you would see your liabilities decrease, for instance. So, paying off debt, for instance, would affect your balance sheet. It wouldn't affect your profit and loss statement, but your business still made $50,000. I would say the most common error is people looking at their bank account and thinking, oh, this is my money. Like, I can do what I want with this money. In reality, it's much more complicated than that. If you have HST debt, tax debt, if you owe your employees some money, if you owe your suppliers some money. So just taking a a snapshot in time at your bank account is not a true indication of how profitable or unprofitable your business is. You really need to be looking at the cash flow statement to really fully understand what's actually going on in your business. So this is what it looks like on a common cash flow statement. I know your eyes are rolling back already. It's like, oh God, here we go. Like, here's the numbers, like clock me out, I'm done. This is, I would say, really only important if you're really trying to figure out where your cash is actually being distributed to, right? If you're really trying to figure out, crap, like I made this much money, but I don't feel like I did, which is a common situation or scenario that you might run into. Having a cash flow statement produced is a really helpful tool for you to truly understand the flow of cash in your business. Depending on the industry that your business is in, this cash flow statement could be even more important. Some businesses like mine is not really important to have a cash flow statement because my business is very consistent, right? I have a lot of monthly clients that I bill at the first of the month. I get paid on the 6th. And then I have my employees' payroll and some subscriptions and other overhead costs, but it's very consistent. A construction business might be not consistent, right? You might have so much cost initially between your labor and materials before you even get paid a dime, right? So, if you're not getting a retainer or deposit upfront, it might take you months to start becoming cash flow positive. And having a cash flow statement allows you to figure out if there's going to be a point in time in the near future where you need to get some money injected into your business. It really determines, and it really makes more sense depending on the business you run, right? So like I said, some businesses don't really need to have a true understanding of cash flow statement. If your business is very consistent, then you kind of know where your business is going towards the next few months. But there are some situations, aka COVID-19, where it doesn't matter if your business is consistent. Having a cash flow statement involved can be a big difference for you. Because if all of a sudden your revenue stops and you still have some overhead costs to be accumulated over time, you need to understand when that cash is going to run out. And this is where the cash flow statement will really help you truly understand that metric. Okay, so quick summary. You still with me? Yeah, everyone's still like, it's all good. So to do a strong financial forecast, you need these 3 reports. They kind of go hand in hand, right? They sort of all speak with each other, right? You have a profit and loss, balance sheet, and a cash flow statement. What I would recommend, if you have an accounting system, whether it's like QuickBooks Online, Wave, Sage, QuickBooks Desktop, whatever, these 3 reports should be quickly and automatically generated for you like that. It should not take you long to generate it. As long as your books are current and up to date, these reports can be spit out in a matter of seconds. So instead of having to recreate the wheel or start from scratch, or trying to understand what the hell is a cash flow statement to begin with, these reports can be spit out on a whim for you. And so Wave Accounting is a free to use accounting software. So it's called the Wave Accounting, WAVE. It's an okay starting accounting system. I recommend Wave if you're a sole proprietor and your biggest worry is invoicing and tracking your accounts receivable, like which customers owe you what. Wave is free to use. How they make money is probably for 2 main reasons, 2 specific reasons. One is you can toggle Wave to get paid for your invoices. Look at Sean already mapping it there. So you can get paid for your invoicing, and that's how Wave makes money. It's like Square. If you ever used Square before, like Square makes money. Like you can use Square for free indefinitely, but Square makes money whenever someone's like, oh, I want to pay my credit card or my debit card. It essentially, Wave makes money by allowing customers to pay by their credit card or direct debit. But I have some clients who don't even toggle that on, and they can essentially use Wave indefinitely. You can track your expenses, you can track your HST, you can track your invoicing, it can do a profit and loss, a balance sheet, a cash flow. So it can do these things for you. It's just not a very robust system. Like if you're incorporated or you have heavy volume, it's not there. And I don't think it ever will be, right? It's a free system. Like it's just not going to invest too much money into the platform, but it's a good starting point. Like if you want to, get your feet wet with an accounting system, check it out. And just an FYI, it's like now it's a kind of a good time to talk to your accountant. If you have one, it's okay. If you don't have one, it's okay. Like don't feel the need to require to have an accountant or bookkeeper. There's nothing wrong with that. But sometimes when you're wanting deeper discussions about your business, having a sort of fresh pair of eyes is a good idea once in a while. Don't feel the need to have one on a monthly basis. We have like 85 clients we manage on a monthly basis, but they need more, right? They need payroll, they need HST, WSIB, they want monthly reporting, they don't want to worry about it. But you don't need an accountant at the end of the day. You can always reach out to one as you need it. But have an accountant or bookkeeper or somebody who can help you out these sort of things, I think is a good idea. Having partnering up with like a lawyer or an accountant or an insurance broker. These are things that part of your business is an important thing I would recommend.
Andrew, Marie has a question.
Yes. Hello, Marie.
Hi. If you were to incorporate, what platform would you recommend?
Yeah, so I think as Andrew mentioned in the chat, I'm a big fan of QuickBooks Online. It's what we recommend with all of our clients. It's quite universal, and Canada has a very strong market share of QuickBooks Online. So you can quickly find resources on YouTube by Googling it. There's courses, there's tutorials. And I think that's an important thing when you're trying to get familiar with QuickBooks Online, is that knowing that you're not alone. And a lot of people sort of struggle with an accounting system at the beginning. Even I did. Like, listen, when I first started learning QuickBooks Online, I wasn't an expert at it. It takes time to understand it, but it's a really good platform. You get a lot of different things, like you can get a mileage log or mileage tracker with your QuickBooks subscription. You can access it on your phone. It speaks with a lot of different applications online. It's a really good platform. You do pay for it. You do pay at least $30-$40 a month, and some subscriptions go up to $150 a month. You don't need that one. As Andrew also mentioned, the starter version is a really good one. It's a good platform. We have some clients that don't have QuickBooks Online and they're incorporated, and that's okay. If your business is pretty simple, you don't need a robust accounting system, but it's one I recommend if you want more, right? If you really want to truly understand your business, having an accounting system in place, I think, is like a fundamental requirement. Good question though. So let's just talk about how to use these reports that I mentioned to its fullest potential. And this might be a bit more nitty gritty, and it's okay. Like if I'm losing you a little bit, just like if you want to stop me, it's okay, and ask any questions. Because at the end of the day, it's it can get complicated, and I understand that. So don't feel bad if you're like, I don't know this. I don't really know what he's talking about, or I'm not fully grasping it. It's okay. Like sometimes it's one of these things you might have to hear a few times before it starts being like, oh yeah, gross profit. I remember Andrew talking about that. Or, oh yeah, my ratios. Like these are things that you might get familiar with it as you go along your journey as an entrepreneur. Okay. So I like to start off. So people sometimes be like, I want to do a forecast. And my first question is, well, what do you want to accomplish? Like, what's your goal? Right? Because people think, oh, my neighbor Bob down the street told me I had to get a forecast in place, or I'm a dum-dum. It's like, no, like at the end of the day, you're not. You need to have an understanding of what you're trying to accomplish, right? Are you looking to expand? That's an example where having a forecast in place might make sense. Are you looking to forecast your financial health in 12 months? Are you looking to pay off your loans by the end of the year? And is that going to be possible? You know, you should always start with the reason. What's the reason behind building this forecast? Building it just to build it, I think it's an easy way to get lazy with it, right? It's like when you're just building it because you want to, it's like, well, I think you need to figure out why you want to build it. For practice is fine. I think doing it for practice is not a bad idea. But when you know that you're wanting to make a decision off this forecast, there is a component where you have to ensure its accuracy and its integrity is intact, right? Because the whole point of a forecast is typically because there's a decision being made from that forecast, whether to get a grant, to get a loan, to make a decision whether you need to expand or sell off your business, right? There's always typically a reason behind a forecast. And I would start off after you have that reason with a sales and expense forecast. That's probably the easiest part. Would you create a forecast to foresee if your business is viable? Yeah, so that's a perfect reason. Will this business idea work, right? I just spoke with a client who wants to build an online membership platform for a specific, I'm not going to go into details, but he built a forecast. And I started questioning that forecast to see, is it accurate? Because a lot of times people think way too optimistic in their forecast. Oh yeah, I'm going to do $1 million by year 3. It's like, well, will you? Like, is that an optimistic approach? Are you being, too loosey-goosey with your numbers? But I would say having a forecast in place to see if your business is viable is very important. If you can help make that decision whether you need to move forward or not before you actually spend a dime, that's huge. Like, think about that return on investment where it can essentially help you make that decision or help you not make that decision. Like, they're both valid reasons to do a forecast in that example. If you want to buy an existing business, well, that's going to be different, right? You have upfront costs, and then your financial model is going to change. So these are all valid reasons. And a reason for you might be different than a reason for somebody else, but that's okay, right? As long as it makes sense for you. So, being optimistic is important, but it's really a matter about being realistic, right? So trying to figure out what is possible in your business when you're building that forecast is very, very, very important. And if you have any historical information, use it, right? Some people, there's a sort of two schools of thought. One school of thought is don't use historical. Your future isn't determined by what's happened in the past. I tend to disagree with that. At the end of the day, having an understanding of what's happened in the past can help predict the future. You can actually see what went wrong and what went right historically. And that should help you make better decisions when you're forecasting your numbers. Sometimes, would it take consideration inflation? That's a great question. My typical answer for that is no, because if you're doing it correctly, your sales and your costs should rise to the same degree. And you can't really predict inflation. Even though you could probably have a pessimistic I guess mindset and saying, oh, we're going to the shitter right now, excuse my language, but you can see inflation is getting pretty crazy. You can just assume the worst. But I typically don't take variables that are out of your control, rising or decreasing interest rates, for instance, what the market looks like in 6 months from now. You could try to predict things you might have an understanding of. If you're familiar with inflation and you're familiar with supply chain management, then great. But if it's something that makes you a bit uncomfortable, I wouldn't stress about it. Like, don't make it too complicated and you're getting too much into the details. It's okay to take a step back and be like, okay, yeah, what's my reason? I'm just trying to figure out if I need to hire an employee. It's like, trying to determine inflation rates shouldn't have a bearing, in my opinion, whether you're going to hire an employee or not. So, I think you're a multi-million-dollar business. Inflation probably has a determined, it's an important part of your forecast, but a traditional mom and pop shop, your retail business, brick and mortar, whatever, I think I don't think it's that important personally. Good question though. It's actually a really good question. Okay, so this is an example of what a very baseline, profit and loss income statement set of data looks like. So you have 3 years. So you have your sales or your revenue. You have your cost of goods sold, which, if you remember, equals your gross profit. So sales minus Cogs is your gross profit. And then you have your operating costs. And then you have your net profit. So very, very baseline. So this is 3 years worth of data. Now, this is very simplified, right? Sales could be made up of 8 different lines. You could have, if you're in e-commerce, you could have, digital sales and physical sales. You could have product A, product B, product C, but it's just rolled up. This is just a rolled up sort of set of, profit and loss income statement. Another way to look at it, and this is where this is for me, the most important part is not just using dollars, but using percentages. Because percentages at the end of the day can shift with your business. Whether you're a $100,000 a year business or a $4 million a year business, percentages is so key. Like I mentioned a while ago about restaurants. The percentages, if you're starting off on the right foot, while you're expanding, your percentages should slightly shift. But if it shifts too much, you can be not in a good position. So looking at, the set of financials here, this 3 years, my brain is already starting to click. I'm saying, okay, I'm seeing revenue growth, right? Revenue is going up year over year. And I'm seeing some fluctuation in cost of goods sold. So, cost of goods sold in 2017 was 40%, then it was 35, and then it was 42. So there's some fluctuation there. So I would ask the client and say, hey, there's some fluctuation. You have a 35% year and a 42% year. What do you think caused that? Could be rising costs of materials, could be decreased cost of materials, could be, a big job the client took on that they probably shouldn't have and took a bigger hit. There's a lot of different questions my brain is going right now when I'm looking at a very basic, set of forecasts right here. But percentages, what I'll say is percentages really tell you a story. Flat numbers are important, right? You made 10,000, 27,000, 37.6. But as a cheerleader for my clients, I would say, listen, in 2 years, you went from 10,000 to 37,000, but your net profit went from 20% to 31%. So that's a huge win, right? Like you think you should have made more than 37,000, but at this rate, if you keep working the way you're working, if those percentages can sustain itself, you're going to be in a really good position in 2020 and 2021 and so on. So percentages really tell a story for me, and it should really help you understand your business's sort of health. So here's a question from Sebastian. The account I use has a template where I declare all my income, then subtract from the numerous categories of expenses. What I get taxed on is the remainder. Is that essentially my net profit? That's a really good question, Sebastian. As a sole proprietor, your net profit is really before taxes. So essentially, if your business made $30,000, we're typically not taking into consideration what you're going to owe in taxes on that number. There is a formula called EBITDA. It's called earnings before, it's so silly, earnings before income taxes, interest, amortization, blah, blah, blah. Don't worry about it. Essentially is when I'm typically talking about net profit, I usually don't take into consideration taxes on that number. Because taxes, I do a separate webinar on taxes, but taxes is like this, where it slowly increases the more you make money at a slight percentage increase. So I usually don't take taxes into consideration because just because you have a business, you could have other sources of income that completely change what your tax rate is. You might have RSPs, investments, rental properties. You might have 3 businesses. You might be employed full-time while working on this business. So there's so many variables involved. So when I'm talking to a client about net profit, it usually doesn't take into consideration taxes. Good question though. So, as I was talking about, you try to build a baseline. So this is historical data, if you remember. Okay, so if my expenses have stayed more or less the same, no, don't be sorry. I love it. Great questions. Guys, listen, there is no bad question. There's no stupid or silly question. A question allows you to learn. A question allows you to grow as an entrepreneur. And I would say my favorite type of client is a client who isn't afraid to ask questions, right? It's like, you want to get comfortable with your bookkeeper, with your accountant. You want to ask questions. Do not be scared. This is okay to ask questions. It's how you learn. It's how you become a better entrepreneur. It's how you make better decisions. So kudos to you, Sebastian. So if your expenses have stayed more or less the same, but my income as a whole has increased without taxes, is that like net profit? Yeah. So essentially, if your revenues increase and your expenses have relatively stayed the same, your net profit has increased. Or another way to look at it is your net profit percentage has also increased, right? Because your expenses are sort of flatline, but you're making more money in your pocket per year. And that's a really healthy sign of efficiency. So if I look at that, I'm saying good for you, because you're essentially able to make more money without having to spend more. And that's a really good sign of an efficient or healthy business. When you're consistently having losses or very small net profit amounts per year, it doesn't mean you're failing. It just means there's either room to grow, as in like there's rooms for you to look at your business, an opportunity to look at your business to figure out what's working well, what's not working well, or you could be in the startup phases of a business. I have some clients are $1 million in losses so far because they're in the startup phases. They're a software company or a tech company, and they're accumulating heavy losses because they haven't even sold anything yet. In the field of art, do you think that the profit calculation depends on the number of sales of the product as well as the extent of the artist's spread in his or her work? That's a good question. I would say for an artist, you would have your cost of goods sold would be like your canvas, your art supplies, all that would be cost of goods sold, because you can't make art unless you buy the supplies. So there's a strong correlation there. It's like if you stop buying the supplies, you're not really making art, or at least physical art. And then your time, well, as a sole proprietor, you can't put yourself on payroll. So your time isn't really an expense per se. But what you do is you take your net profit of your business and you figure out how many hours you allocated towards your business, so you can figure out what your hourly rate is. This is a sort of a separate discussion, talk about like under business taxes and stuff. Hopefully that answered your question, Yefa, but I know it's a bit of a complication discussion point.
Do you mind, can I add something?
Yeah, please.
Thank you. So I was wondering as well, because as you see, as an artist, you almost work all the time. It's a full-time job, right? Because you meet people, you go for events, you promote for your work. So it's really hard to, as well, yes, as you said, the timing, like, because it's a full-time job and it's every little second you're thinking about a new idea or a new project you want to create. So if it's just for the material and the products we're selling, I think it will be very simple than paper. And this one thing, because I don't think I'm looking at the sheets and this is too much. I don't have anything to fill all the sheets. As you said, it's material and I create, and here are the products, but also the project, the community events, being capable to, host an event, or someone is inviting you for an interview. I think it's not only about the money that I'm gaining, but it's a spread of the word.
Your time, yeah.
And this is why it's hard to calculate it, like really with numbers, at least for me. And again, I will say sorry if it's easier for other people. It's not easier for me because I'm not sure how can I count this hours, right? Because it's every little details. This is first. Second, do you think it's okay if artists especially will need someone to help them with paperwork and just to finish with it, like here I bought this stuff and I sell at that much? So if I'm not really good at numbers, it's okay to ask for help to fill this, even in this process, in the workshop itself.
Yeah, so question one, I would say, if time is your commodity, if that's like, if you're a service-based business essentially and you sell products with that, if you're not incorporated, and I'm not saying to incorporate because of this issue, I would not recommend that ever. But when you're a sole proprietor, you can't pay yourself as wages or payroll. It's not a thing as a sole proprietor. Like your net profit is your wage. I guess a way to look at it is internally allocate how many hours a month you think you'd be working on your business, and calculate that roughly on a weekly, monthly basis, whatever it is, and take that number into consideration of your net profit expectation is, and that'll give you roughly what you are essentially paying yourself per hour of work. Don't be surprised in the early stages you're making like $8 an hour or $10 an hour or something scary. It's okay. Don't sustain that hourly rate after year 1 or year 2. It's okay, and it's okay to have difficulties in this process. Was what else? It's less than that. Hopefully not. Right? Like at the end of the day, we had a question early from Marie is, would you do a forecast to determine if your business is viable? If you're not paying yourself, this is going to be a scary thought, okay? But if you're not paying yourself minimally an hourly rate of minimum wage, is it worth it? Is it worth it to go through the stress and headaches and, sometimes some depression? I'll say is that you will go through some difficult times as an entrepreneur if you're not paying yourself basically minimum wage, right? You have to make a difficult decision sometimes in your business, and it doesn't mean you're a failure. It means you're making the right decision for you on a personal and mental and spiritual level. It's okay when you're building a forecast. It might say, shit, this might not work today, might work later, or you might need to pivot and make some slight changes in your business. But you need to pay yourself minimum wage, bare minimum. Like at the end of the day, that's not even enough to live off of. You look at the cost of living statistics in Canada and Ontario specifically, like you need to pay yourself bare minimum wage. If not, just right. You get my point is at the end of the day, it's important to make that distinction. And I'd say by year 2, year 3, if you're not sustaining a decent wage for yourself to live off comfortably, sometimes you might decide to not go through that trial and tribulation on a spiritual and personal level. So one way to do that is you figure out your net profit. So if I look at 2019, 37.6 thousand, if you're working 20 hours a week, you can do the calculation to figure out what you're paying yourself per hour roughly, right? And that's what it kind of comes down to. Your second question, which is, do you need somebody to help you out? I think it depends on what you're looking for. At the end of the day, your business is not complicated in the sense where you have sales and materials. That's very basic. You don't need it. You don't need anybody to help you monthly. You can honestly come to a firm or a tax preparer or anybody once a year and say, here's my stuff. It'll probably take 2 hours, 3 hours of work for all intents and purposes. Because it's like, again, it's just materials, some supplies and advertising costs and your sales. Like that's not a complicated business. A complicated business is somebody who has payroll, HST requirements on a monthly basis, or you have WSIB, you need monthly reporting to make decisions. Like that's when it becomes a bit more complicated. Hopefully that answers your question. Okay, a few more questions came in. As a sole proprietor, how do you draw income and show on the books? You don't show on the books. You don't show it on the profit and loss. You show it on the balance sheet. So it becomes a balance sheet item when you're drawing out money. It's not an expense as a sole proprietor. It's probably one of the most important concepts to understand when you're building either a forecast or trying to understand the profitability of your business. As a sole proprietor, paying yourself. Here's a perfect example. I hopefully have time, but like Shauna's like, oh God. If your business makes $100,000 in net profit and you pull out zero, you're still getting taxed on $100,000, regardless if you took any money out. The other side of the coin is if your business got a loan for $1 million and you pulled it all out, you're not paying any taxes either. You owe $1 million. You're probably not in a good situation, but for your business made zero still, right? So, having taking money out or putting money in, for instance, as a sole proprietor, has no bearing on your tax situation. So, differences between a corporation and a sole proprietor, that's a different discussion. There's a lot involved on there. I would say is I typically do a business taxes webinar that goes through that. The profit of the business is the personal taxable income, the draw of the sole proprietor. You do not need to make additional entry in the accounting books. Personal, yes, but the draw itself is not the tax component. The draw is just like I mentioned, it's a balance sheet item, doesn't affect the profit and loss. And you can take zero out or all of it out, and that has no effect or bearing on your tax situation. Okay. All right. So as I mentioned, what I'm seeing here is your sales increased by year 1 to year 2 by 30, and another 40 by year 2 to year 3. Or another way to look at it is your sales increased by 60% and then by 50%, right? So looking at dollars sometimes doesn't really appeal to you, but looking at percentages makes sense. Yeah, my business increased by 60%. That's so much easier than saying my business increased by $30,000 of revenue. It gives a different perception. And I have some clients who are like, oh my God, my business only did this, but it's like, yeah, but it also did this by this percentage. Like, oh crap, I didn't look at it like that. It's like, yeah, like, don't just use dollars, use percentages as well. If I'm looking at this, the cost of goods sold average is 39%. So now that's a baseline for me, right? When I'm trying to do future forecasting, I can safely assume that they should roughly have a 39% cost of goods sold, when I'm doing my forecasting. Operating costs is now at 32,000, or net profit is averaging 30%. So I can use these indicators or baseline figures to help make better decisions when I'm building my forecast. And, at the end of the day, once you can determine what you think your sales might be in years 4, 5, and 6, you have your percentages, right? I actually will be able to know very quickly if you tell me, I think I can do $200,000 of sales in 2020, I can safely and accurately make a prediction of how much profits your business is going to make just based on that sales number now, because I have a good understanding of your historical data. And it's why I think history makes it important. It's an important process in making decisions in the future. Okay. So, a quick assumption, I'm not going to go through this. This is kind of detailed because we have like 5 minutes left. So I believe Shauna, what's up?
Sorry. I was just gonna ask Andrew, maybe because a lot of participants are like literally starting out, so they don't have a lot of information they can pull from.
Yeah.
Is there a way that
I'm gonna skip this part.
Okay.
yeah, just don't worry. Okay, so I might even just skip all of this, to be honest, at this point, and I'll just talk. Let's see here. Okay, here's a good one, right? So a forecast is essentially a prediction, like I mentioned, and a budget is a plan, right? I plan to spend this much. I plan to make this much money, right? So you're predicting your financial health, and then this prediction will help determine how you plan on using those profits. For instance, whether you wanted to pay off your loans, whether you want to invest that money, whether you want to pay yourself some of that money out personally. They go hand in hand. Budget is more short-term. It's like, okay, I'm going to have a 3-year forecast, but I'm going to budget on how I'm going to allocate that money this year, right? So that's essentially what's happening is they sort of go hand in hand. And kind of, a budget is very short-term, 6 months up to a year. Forecast can be really up to 3 years. I don't recommend more than 3. I typically don't recommend more than 2. It's so hard to predict that far in the future. Okay, quick FAQ. How many forecast plans should you build? I typically recommend 2, a worst case scenario and a best case scenario, right? Because at the end of the day, you might have, things might not totally work out for you in the beginning, and it might take you longer to kind of get your foundation settled, or you might just start rocking and rolling from day one. So it's like having a good snapshot and making sure you're covered for the worst case scenario is really good. How far should you forecast? Like I mentioned, I wouldn't go more than 3 years. I think 2 years is a really good spot to be in, but 3 years is definitely quite common in today's sort of economical state. Well, it's really not, but should you build yearly or monthly forecasts? I like monthly for the first year, and then quarterly or yearly for the next 2, because you can more accurately predict the first 6 months on a monthly basis. But then after that, after this first 6 months, first year, you're pretty much like closing your eyes and throwing a dart to a dartboard. Like, if I had to look back at my own forecast, it's kind of funny in retrospect. I'm like, yeah, I can do this. And like by year 3, it's like, I completely shattered that, right? Like I was like, yeah, maybe I'll hire 2 employees or 3 employees by year 3. I have 7 full-time right now. It's like, I didn't predict I was going to buy a building. Things change, right? Your business will evolve and it will change. So don't think too far. And like Shauna said, 2 years is a sort of it's a really nice spot to be in. How important is the cash flow statement? Like I mentioned, I think at the end of the day for small businesses, it's only important if you intend on actually using your excess profits to make like large purchases or debt repayments. I really highly recommend to focus on the income statement. Like that, like is your bread and butter in your forecast, right? Your revenue, your expenses, your profitability. It's so important. Question 5, what do you use a balance sheet for? Helps determine your liquidity and ratios. Is there software? Like I mentioned, your accounting solution can do it. Or if you want a dedicated third-party software, look at something like LivePlan or Fathom HQ. They're like monthly subscriptions, and it can really help you make a very analytical, detailed cash flow or forecast. But it does cost you some money. Just quick reminders: forecasting can be a slippery slope. Remember to take a step back and ask yourself why you're building a forecast in the first place. Don't shoot for the moon. Be realistic. And forecasts are like budgets. They're flexible. You can modify them because new information will always present itself. So think of it as a live, living document. Don't think that it has to be set in stone and you can't ever touch it again. Don't be surprised every 3 months, every 6 months, you're actually walking back into the forecast and be like, okay, I got to make new changes into it because something in my business has evolved. Ask for assistance, right? Enterprise Center, ask your accountant, ask your neighbor, ask somebody if you're ever stuck and needing help. That's a really good idea. So a very quick example. These are some different situations where we have helped and built forecasts for our clients. So whether they can expand their business, to project profitability, to pay out bonuses, if the business can take on more debt, build a valuation, and to highlight, as we talked about, if a business can succeed or not before it's even created. Sorry for the rush on the last 8 slides. So kind of went through that a little too quick, but yeah.
No, that's great. Thank you, Andrew. Yeah, there's always lots of questions around this particular topic because everybody doesn't always feel very comfortable with it. But I think you covered a lot of the main highlights. And just like Andrew mentioned, if you're stuck or if you need further assistance, that's what we're here for. So you're welcome to send me an email. One thing that I just want to make sure is really clear is that you're forecasting. So based on all of the information and all the market research that you've gathered up until this point, you have the knowledge to be able to forecast for your business out 2 years. So like Andrew mentioned, it doesn't have to be perfect, and it's a moving, flowing target. But for our purposes in the program, use your knowledge and apply it as best you can. And if you have questions from there, then we can help plug in the places that you're not sure of. Well, Andrew, thank you again for your time and your wealth of knowledge on this particular subject. Hopefully we'll be able to have you back again and maybe talk a little bit more about those taxes that you referred to in your presentation. And if anyone has any questions, send me an email. And I could either, if I can, I'll answer it myself. And if not, I'll forward it to Andrew to get some advice from him. Okay.
Yeah. Thanks, everyone. So just it's okay to not be the greatest at this at the beginning. It's okay. It's normal. You're human. I suck at a lot of things, right? And even till today, 4.5 years later, just know that you'll make mistakes. And it's why I mentioned it's okay to ask for help. And Google is your friend. If you're stuck, if you need some clarity, definitely Google it. But just try to have fun a little bit with the process, right? You're trying to figure out the profitability to sustain your lifestyle, right? It's like, that's a fun thing to be looking at in regards to your business. And at the end of the day, it's an important thing to do. It's an important thing to kind of keep on top of it, but you're going to suck at it at first, and that's okay.
That's good advice. Just a reminder for everybody, our pitch presentation is on Thursday with Shannon Ferguson. It's a hybrid, so if you can't make it into the office, then we will have it by webinar through Zoom. But if you are able to make it in person, then it will be at the McLeod room upstairs at Civic Complex. Okay.
Thanks, everyone.
Great.
Bye.
Thank you. Have a great day.
Take care, guys.